Monday, September 7th, 2020, Maneco 64, home of alternative economics and contrarian views. In this video, we're going to look at how the international monetary system has become a casino. And to do that, we're going to look at the past. So we're going to go back to the Bretton Woods system and how it broke down. The temporary suspension of the convertibility of the US dollar into gold at a rate of $35 per troy ounce of gold on August 15th, 1971 meant the end of the fixed exchange rate regime, and eventually all the other major national currencies adopted a floating rate regime versus the dollar too. Under the Bretton Woods system, the dollar was fixed and convertible to gold at $35 per troy ounce, while all the other currencies' exchange rates were fixed versus the dollar. So indirectly, all currencies were linked to gold. That system worked very well for 20 years, from around 1944 to the mid-1960s. But unfortunately, under the Johnson and Nixon administrations, the US government followed a policy of deficit spending, or more commonly known as guns and butter. So the Vietnam War is the guns, and the Great Society, a socialist project, is the butter, right? The fiscal deficit spending led to the US running trade deficits with its major trading partners in Europe, who were left holding a surplus of dollars, but quickly realized the US was abusing its exorbitant privilege to issue the world's reserve currency under the Bretton Woods Agreement. So countries like France, Germany, and the UK started redeeming or converting their surplus dollars for gold, and gold therefore started to flow out of the US Treasury. By 1968, the system was starting to show cracks as the international price of gold in London started to rise away from the fixed rate of $35 per troy ounce. So eventually by Friday, August 13th, 1971, the price of gold had traded back up to near its 1969 high above 43. And so a couple of days later, on Sunday, August 15th, President Nixon decided to default on the promise to pay at $35 per troy ounce. Some people call it the closing of the gold window. It is a default, of course, as well, even though that term is not used regularly, of course. So here's the drop in US gold reserves in the 60s, from around 20,000 tons to around just under 10,000 tons in the late 60s. So why was gold part of the monetary system? That is a fair question, as it is a subject that has been ignored by academia, the mainstream press, and most financial sector economists. The truth about gold is that, as Bernard Baruch once said, and I quote him, "Gold has worked down from Alexander's time. When something holds good for 2,000 years, I do not believe it can be so because of prejudice or mistaken theory." The other truth about gold was revealed by J.P. Morgan, who once stated the following at a congressional testimony: "Gold is money, everything else is credit." For centuries until 1971, gold had performed its function as a tool in the free markets, as it acted as a unit of account, as a medium of exchange domestically and internationally, and it was and still is a stable store of value, as well as being a neutral or non-political form of money. The other quality gold has is that it is universally recognized as money everywhere around the world. So what could President Nixon have done differently other than wrecking the international monetary system or the Bretton Woods Agreement? The normal thing, of course, would have been to allow the free markets to adjust interest rates higher, because that would have attracted foreign investors, foreign central banks, into the dollar. They would have kept their dollars or even bought dollars and put them in dollar deposits at higher rates. But of course, President Nixon, being a politician, forced the Fed to keep rates low quite a bit in that era. So that's why the gold started flowing out. We know politicians always want plenty of credit in the system in order to buy votes. So allowing interest rates to rise would have been a politically difficult decision for Nixon. But of course, it would have been the right thing for the country and the rest of the world, I would have said. The other thing the US could have done is that it could have devalued the dollar or raised the price of gold, but that would have been a massive loss of face. So Nixon decided to suspend convertibility temporarily. Of course, it's been temporary for almost 50 years, right? And it's going to be 50 years August next year. So the international monetary and trade system can only function in an honest manner if nations around the world use gold as a foundation or anchor for their national currencies. Having floating exchange rates for national currencies is like changing the length of an inch or centimeter every day. Can you imagine that? It would be really difficult for architects and all other kinds of things, right? Some would argue that gold backing and a fixed exchange rate is not a free market, but forget that gold is a tool in a free market that acts as a medium of exchange, a unit of account, and a store of value. As economist Judy Shelton once said, and I quote her, "We have turned money into a lottery instead of being a tool." She also said that the international monetary system is a casino and money has become a game. So we only need to look at the foreign exchange market to see how the current system has made money a game and the system a casino. According to Statista, the daily turnover in the global foreign exchange market in 2019 was 6.595 trillion with a T dollars a day, while according to the World Trade Organization or WTO, total merchandise and commercial world trade amounted to 25.1 trillion per annum in 2018. So the foreign exchange or forex market's annual turnover was 95.9 times bigger than annual merchandise and commercial world trade. That just is quite amazing, isn't it? 95.9 times bigger. So since 1973, the major beneficiaries of this non-system or floating exchange rate system have been the banks, as they are involved in payments and transfers across countries, and also speculators like hedge fund managers. I mean, when something changes every day, there's a lot of opportunity for people to speculate, right? As we saw earlier, money is supposed to be a tool or utility that helps not only bankers and speculators, but also the rest of the public in assessing the demand and supply of goods and services in a free market capitalist economy. So if the money changes value every second, how are we to have a monetary or international trade system that helps promote free markets, capitalism, and opportunity for all? Not just the 1%, right, who have been benefiting from this system. So there you go. That's how the international monetary system became a casino. Of course, it didn't happen overnight. I would say a big part of it, of course, was Nixon's decision on August 15th, 1971, to lift the anchor of the system, the gold anchor, of course. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great rest of the day. Take care. Bye.